Next, I'll move on to stocks. So this is the sort of most popular method that most people use. And at its most basic, it's actually just a unit of ownership in a public corporation. That's what a stock is. So that entitles you to one unit of ownership. There could be 500 million units of ownership out there, 500 million shares. But if you have one, you own that one out of whatever is issued. There are a lot of different types of stocks, but I'm going to focus on common stock, which is the one that you'll see in the market, the one that you'll see that's actually traded most frequently. You'll find some others out there as well. Google, for example, has Alphabet has A shares and B shares and all this sort of thing. I'm not gonna get into that. I think that's it just depends on the company, depends on how they decide to structure it. But common stocks are the most common, oddly enough, and they basically represent one ownership share and one vote in the company. So companies will have annual meetings where they'll have shareholder votes on certain issues, and then that actually entitles you to vote on those issues. These are traded publicly on stock exchanges. We all know this, and they might have a dividend payment or they might not. Depends on what the company chooses. So if you buy a stock, you could get a regular payment, or you might not. Again, it's totally discretionary, totally up to the company. At its base, the value of a stock, the value of a share in a company, is essentially the value in today's dollars of all the money the company will ever make. So companies are assumed to last forever, right? And then so what we do is we actually make a prediction about how much money, how much profit actually the company will take in for the rest of time, and then we convert that into today's dollars. I'm not going to go into the technical aspects of how it's done. It's just I want to give you a conceptual idea of how that is set. And so what happens is when you see stock prices fluctuating based on some news, right? Let's say Tesla tomorrow announces they've sold 300,000 cars, right? This is obviously a made-up example, but let's say they announce they've sold 300,000 cars. So what that means is their stock price is going to shoot up. And the reason for that is that they've sold 300,000. People expect them to continue to sell at least that many into the future, forever. And in fact, they expect more than that. And so the stock price will shoot up to reflect what people think the value is of all those sales into the future. And so whenever you see news like that, either positive or negative, affecting a company's stock price, that's why. It's because that piece of news has altered people's predictions of how much that money the company will make over time, and that's then reflected in the amount that they're willing to pay for its stock.